Welcome to the Insolvency Law podcast, providing specialist insolvency and debt-related advice for business owners and individuals. For more information on debt recovery, business restructuring, and personal and corporate insolvency, visit our website www.insolvencyandlaw.co.uk or call us now on 020 7504 1300.
Hello and welcome back to the Insolvency and Law podcast. Insolvency and Law is an award-winning consultancy firm specialising in insolvency, debt purchasing and business rescue. And welcome to our third show. Once again, we will be really honing in on the world of investments and going into further detail about a multitude of aspects. In our first two episodes, we covered an introduction into Ponzi schemes and missed payments, so go and check those out and give them a listen. So today I'll be speaking again to Director Peter Murray as we delve even further into the nitty-gritty. And this week, the spotlight is on signs and red flags, how to spot a good or bad investment prospect. Welcome back, Peter.
Sarah, good morning.
Morning.
It's a pleasure to be with you.
It's a pleasure to speak to you. Peter, in our first episodes, we talked about how there are red flags and signs to look out for that can help you make an informed decision on whether or not to take the risk of an investment, right? So I imagine most people listening to this are interested in making an investment or have done, whether seasoned investors or not. So I wanted to start off on a positive note and ask you, to kick off the episode, what would a good investment prospect look like to you?
A good investment prospect for me would have that all-securing badge, so to speak. And that is a badge that says regulated, by the Financial Conduct Authority. So if an investment is a regulated investment by the Financial Conduct Authority, that's, for me, is the beginning of what I consider to be a good investment proposition. That is not to say, though, Sarah, unregulated investment propositions are not good investment propositions.
Okay. So other than regulation, what else kind of tells you this could be something good, but not too good to be true?
Well, I would then need to dive a little deeper and undertake some type of due diligence. And this can be undertaken by your average savvy investor, and that's really finding out information about the company's standing in the marketplace, finding out about the management within that company, finding out about the company's track record. And these things, one can find out with the benefit of online access. There's much you can find out about the management and the company and its performance and so forth. I would want to commit to do that before parting with my funds in any investment proposition.
Is somewhere like Companies House worth looking into, or does that not really tell you a great deal about the company?
Well, it's a good start because Companies House, should tell you when the company was incorporated, how long it's been going. Then you can go on to Companies House. You can find out some financial information about the company. You can review the company's recent trading accounts going back, the years since the company has been trading. Companies House, you can find out who the directors are. And once you know who the directors are, you can then make inquiries about the individual directors, to see that they have a clean bill of health, so to speak. And again, you can also go online and see if the company has, see what digital footprint the company has, if they're quite active on social media, or, look at their relationship with social media. And then, of course, if you can obtain a credit history, you can go online and obtain a credit report on the company to see if the company has been a subject of any adverse legal proceedings, such as county court judgments or winding up petitions or administration orders or CVAs. And, you can find that out if you acquire a credit report from, an established source. So there's lots of ways, in which to find out the viability of those companies or management promoting an investment proposition.
Wow. Thank you for that. It's incredibly insightful. But would you also say that it's probably not entirely foolproof because every investment is a risk? Is that accurate?
Yeah. I mean, the difference between, say, regulated investments, there is a fallback where if it all goes terribly wrong and the company goes bust, etc., there is a fallback because the investment was regulated. I should say, then in all probability, you will be entitled to compensation to recover some of your funds that way. But with unregulated investments, if it all goes terribly wrong, then you're going to really have to rely on the administrators, liquidators, on the proceeds from any insolvency, which generally speaking is very little or anything at all.
And that's interesting because a lot of people seem to buy into these unregulated companies. It's scary because clearly whoever's at the helm or whoever's doing the selling, so to speak, is really selling the heck out of it, because you've got people who are, intelligent, savvy, maybe done it before, and giving over their money to an unregulated company because the prospects look shiny.
Yeah, sure. These prospects will look very shiny, Sarah. And it's just because investors, they want a better return than the banks can offer them.
Yeah.
The banks are not even offering 1%, and investors want more than 1%. So they will turn to unregulated investment propositions in order to achieve a greater return on their investments.
So I guess it's important to say, if somebody wants to invest in an unregulated company, you need to know it's a huge risk. It's going to be a risk.
It can be a huge risk, and it really does depend on what the investment proposition is. It also depends on how stable the company is. And, you've got to take into account a company's track record, although past performance is no guide to future performance, but you should take into account a company's track record. Most certainly. And you really got to examine the investment opportunity. You really got to, examine that opportunity to make sure that it is something that you really want to do. But let me repeat, not all unregulated investments go wrong, but a vast amount of them do go wrong. And sadly, investors end up recovering zero from their significant investments.
Absolutely. And sadly, it feels like, once there's kind of no way of knowing which way it's going to go, because as you say, some unregulated companies are fine. They're great. And you get a great deal from them. It's a good opportunity, but then some of them aren't. So there's kind of no way of knowing which way it's going to go in a way. Like, it's kind of a gamble, isn't it?
To an extent. I mean, just going into an investment proposition itself is a gamble. And it just comes down to the risk you want to take. How risk averse are you? Or, what is your appetite towards risk? But generally speaking, look, a lot of these unregulated investment schemes will have been set up for a good purpose, and they, their purpose has been established, and they're producing returns for their investors over the years. But again, an equal amount of these investment schemes, they do go wrong, and they go wrong for a number of reasons. And it's usually, lack of investment skills. Sometimes the investment managers, or those who are in control of your funds and who will make the decisions to invest and to provide you with a return, sometimes, those individuals themselves, they lack the requisite skill to do what needs to be done. And it may well be sometimes they've over-invested in particular areas, or they have an inexperience in what they are doing. And, inexperience will come home to expose you And if it exposes you, then of course your investors will suffer because they won't get the expected returns.
It's funny, isn't it? Because these people can probably sell it really well, but they don't necessarily have the expertise to follow through.
Yeah. And because they know if they put a proposal into the marketplace or target specific types of investors, and if it looks good, investors will buy into it. Well, most investors will buy into it. The amount of investors who do not undertake just a basic level of due diligence is incredible.
Really?
It's frightening, actually. Investors are quite prepared to part with 50,000, 100,000, 200,000, 250,000. They're quite prepared to part with huge sums of money just by reading what we call a shiny investment proposition.
Yeah.
And they'll probably read about it online, or they're part of an investor group, but via WhatsApp or some other, social media group. And because everyone else are sort of like piling into this investment, they go and pile in themselves too. And because everyone else is piling with 50,000, 100,000, 250,000 pounds, if they've got it, they do likewise. And
that's a really good point.
Yeah, you quite easily, because sometimes you just get, caught up in this vortex of like enthusiasm. You just go with it. If your co-investors are telling you that, they're doing 100,000 or 150 or whatever, what's stopping you from doing the same? And the thing is, sometimes you may get your first return maybe 6 months from now or 12 months from now, and then you get your second and your third, and you might be encouraged because you're seeing these interest payments come back to you. You're then encouraged to invest more money, so you invest more money, and then further down the road, guess what? No more interest. And if you're not getting your interest, you've got no chance of getting your original capital investments back. And that's why you do seriously need to undertake at least a basic level of due diligence before committing certain sums of investment.
Yeah, and to be honest, the point that you raised is really key, is that when they see other people have invested, that to them is like the due diligence. Oh, I can see that, I've got like 3 friends who have invested in this company, and there's actually like 200 other people that have done it, so it must be fine.
Yeah.
It's so they think, well, I don't need to do the due diligence because I know like a massive group of people that have done it. But that's not enough, because you don't know what's going to happen down the line. And those other people may not have taken on the due diligence they were supposed to, or maybe they did. And this is very, it seems to be quite complex, because everything can, like you said, can be fine to begin with. You're getting your returns back, and then it goes a bit wrong. So it's a really tough one, because you cannot predict the future.
Yeah, but there are some really there's some really obvious red flags that investors should look out for when investing in unregulated investment propositions. And I say there's nothing wrong with investing in unregulated investment propositions, but for heaven's sake, before you do so, you must check it out.
Absolutely.
You must do your due diligence.
And that flows really nicely to my third and final question, which is possibly the most important one of the day, which is, what are the red flags, as we say? What are some key things for people to look out for, whether they're seasoned or not?
Okay, I mean, in the past, and I'll no doubt I'll see it today and in the future, where you're undertaking some basic due diligence on the company that's promoting the investment proposition. And guess what? There's only one loan director. Well, why is there only one loan director? The company that's going to, receive millions of pounds of investors' funds, maybe tens of millions of pounds of investors' funds, but there's only one director? Really? So when I see just a loan director, for me, that is an instant red flag. Another red flag, if the company has no trading history, which you will find. You'll find that the company was incorporated a year ago or 2 years ago or 3 years ago. I want to put my money into a company that's got at least 5 solid years of trading which they can evidence to me. So, a company that's been going for less than 5 years, for me, that's going to be a red flag. And again, if the company has charges over its assets, it has fixed and floating charges over its assets, that to me is another red flag, because it means if it all goes pear-shaped, the creditor that has a fixed and floating charge is the first to get paid and not me. So, charges for me would be a red flag. And any adverse legal proceedings recorded against the company, for me, that will be a red flag. So these are the things, anyone can find that out. Just go onto Companies House. You can see when the company was incorporated, see their accounts. If their accounts don't look healthy, again, to me, that is a red flag. And again, I want to see some web presence about the company. I want to see that the company comes up in blogs or podcasts or, other independent, credible reviews.
And social media, because sometimes, and this isn't saying every
even
company
social
needs
media
to have it, but sometimes when you do have social media, it gives you that, you can sort of sense a bit of credibility if you've got, people interacting with you on social media. Surely,
I want to see their social media engagement. And when an unregulated company promoting an unregulated investment proposition, when they haven't got these presence, you must ask yourself why. And that's got to be red flags. If they haven't got a social media presence, if they haven't got a digital footprint, if you can't find positive testimonials, positive reviews for the company and the investments online, these are red flags.
And Trustpilot, of course, is a great place to start.
Oh, definitely Trustpilot.
If there is anything on the company, please do read it, because you'll see.
Yeah, definitely Trustpilot. These are red flags. But the amount of the investors, they just don't, undertake this. And it's a very basic level of due diligence.
That is basic, yeah.
You haven't got to, as long as you've got your phone with some internet, you haven't got to leave the comfort of your chair. You can do it having a cup of coffee and just go online and do your basic due diligence undertaking. And, you haven't got to sign up and pay to become a member, of organizations or, to get information about companies, because the basic level of due diligence is freely available online. Companies House website, the Insolvency Service website, and Google, and just online generally.
No, absolutely, Peter. And I think it's worth honing in on the fact that if there is zero online presence, it's most likely a dud.
Yeah,
there's just nothing on it at all.
Yeah, I've seen companies that look absolute. The investment proposition looks so solid, and then when you get behind it, you find out it's one person. This company, where are they based again? It says one individual. He was operating out of his bedroom in Lithuania. There you go.
Wow. Just to go on to the investment prospect and when they're selling it to you, we did touch on this in episode 1, but I think it is worth bringing it into this episode to round off as well, that when in the proposition, what are things to look out for that might be a bit suspicious?
Growth rate. Look, the banks aren't even giving you 1%. To get 1% from your bank, you need to put more than £1 million cash in. So, if you're getting returns or being offered returns in excess of 8-9%, it's not a red flag, but you really need to investigate that very, very closely. How can you give me this level of growth on my investment? You just got to just get behind it and just look into, why is it possible? Can I really achieve this much? And again, it goes back to looking back at what has this investment proposition achieved in the past. And don't look at the past 12 months. You really need to go back, 5 years. And if it's a relatively new proposition that's only been going for the last 2 or 3 years, well, do you really want to go into a proposition that has no track record? Do you really want to be first? Can you afford to lose? Can you really afford to lose what you are about to commit investment wise? If you can afford to lose it, then perhaps, you may not be so hot on doing any further or any, serious level of due diligence. You may go with your gut, or you may go with your gut and your initial thoughts. But in this day and age, you've got to do your due diligence.
Yeah, absolutely. And, it's important to also mention, and I'm sure you can kind of expand on this, that the prospects they'll give you, if they're giving you sort of like a promise of a high return, is that like in spite of market conditions? I think is that also something to highlight, that in spite of what's going on in the industry and in the markets and all that they're still offering a high return. That's quite suspicious.
Yeah, but again, it really does depend on what the investment proposition is.
Right.
Some investment propositions can give you genuinely extremely good returns. But it really does depend on what that proposition is. And I can't tell you what that proposition is without seeing it and reviewing it and doing my research into that proposition. And then I can confidently say, well, yes, I'll do this, or no, this is not for me.
Right. So it's just about doing some research. It's as simple as just getting a little savvy if you're not already, and not blindly handing over money, which I know, like we said, it sounds really simple and common sense, but it's clearly not happening a lot, and people are just being a little too trusting, it seems.
Yeah, people are being trusting. Well, look, Sarah, consider this. Let's just say you parted with £50,000.
Yeah.
And you're told that, every 6 months you're going to get a return of, say, every year you'll get an annual return of, say, 10%, but it could be paid half yearly. So you get 5% 6 months and 5% 6 months thereafter, and 5%, every 6 months. First 6 months, you've had your 5%. Second 6 months, you're in for 1 year. You've had 5% again. 18 months time, another 6 months, you've had 5% again. I mean, if you've got more money sitting idly by, achieving less than 1% in the bank, you'll probably want to remove that funds that's achieving less than 1% and move it across where where you believe you'll get 5% every 6 months. Because guess what? The last 18 months, you've been getting 5%. So now you've gone from moving your 50,000, which was your initial investment, and you've got a further 200,000, and you move that 200,000 across. So you're now totally invested 250,000, and you're expecting to get your 5%, and you may get your 5% again on the fourth round. But at some point, your interest will stop coming. When your interest stops coming, it's only a matter of time before the company fails completely. Because once you see a missed interest payments, that is the first sign the company has financial difficulty. And usually as night follows day, within months, the company will go into some statutory insolvency process.
I think that's a good place to leave it, Peter. I think we could talk about this all day, and
yes, we can.
We will be doing further episodes on the world of investments, so stay tuned on that. But thank you so much, Peter. That was absolutely incredible and insightful. So thank you so much.
My pleasure. You're welcome.
We hope you join us for our further podcasts, and please do check out the first two. They are also incredibly insightful, especially if you're looking to invest and you're interested in that world. Get onto it and listen. So thank you, everybody, for listening, and we'll see you next time.
Thank you, Sarah. Bye for now.
Thank you. Bye.
Thank you for listening to the Insolvency and Law podcast. If you require additional guidance on any of the topics we covered today, visit the Resource Centre at our website, www.insolvencyandlaw.co.uk, or call us now on 020 7504 1300.